General Mills just wrote off nearly $3 billion across its pet food and Brazilian divisions, yet somehow their adjusted earnings per share still managed to rally. Welcome to Earnings Unscripted. It is July 1st, 2026, and we are unpacking the fourth quarter results for General Mills, ticker GIS. And Miro, it is a very weird quarter when you can set billions on fire and Wall Street actually cheers.
Yeah, the market loves a good magic trick. And before we pull back the curtain on this one, I should probably do the legal bit. Just a quick reminder that we are sharing personal opinions today, not financial advice, so please do not go buying cereal futures on our behalf. But look, Susie, the disparity here is staggering.
Right. I mean, you look at the reported numbers and they are just terrifying. A massive $2.01 billion net loss. That comes out to negative $3.74 a share.
But that is almost entirely non-cash impairments. If you strip out all that noise, and it is a lot of noise, adjusted EPS actually came in at 95 cents, which is up roughly 48% quarter over quarter.
Which the market completely ate up.
Absolutely. I mean, the stock it bled out all quarter long, falling over 23% leading up to the report. But then today, right before the call, it just reversed, gapped up at the open, and ended the extended session up nearly 8%. People are ignoring the massive write-downs and focusing purely on those adjusted margin wins.
Okay, but we really need to talk about what they actually wrote down because it is wild. $1.8 billion of that hit is tied to their North America pet segment. Things like True Chews and Nudges. They specifically called out their Wilderness brand dog food, basically taking a nosedive.
Right. It's the death of the humanization of pet food thesis.
Wow. Okay, grim.
No, but think about it. Consumers are completely stressed right now. Management admitted that shoppers are just hunting for promotions. They simply refuse to pay full everyday shelf prices for premium kibble. It dragged North America pet sales down organically by 3%.
Wait, but revenue actually ticked up overall to $4.61 billion.
Sure, but a lot of that, well, let me say that better. They squeezed profit out of a scheduling quirk. It was a 53rd week fiscal year, plus they leaned heavily on their internal margin management programs. So adjusted operating profit hit $705.4 million.
Right, and adjusted operating margin popped up to 15.3%. So they're moving fewer physical boxes of food, but still guarding their bottom line. Though, honestly, having to take an immediate billion-dollar pre-tax loss just to dump the Brazil business tells you exactly how desperate they are to protect those margins.
Yeah, exactly. They're jettisoning weight wherever they can.
All right, well, there's a lot to unpack there, especially this $3 billion supply chain heart transplant they just promised. Let's get into the details.
Yeah, heart transplant is exactly what it is. Look, you do not announce a $3 billion structural teardown unless you are staring at some very ugly realities. They want this fully operational by 2030. And actually, let me check. Yeah, $750 million of those savings are expected immediately next year in fiscal 2027.
Which is a huge acceleration. But wait, why now? General Mills has been running their holistic margin management program for years. So is this just that on steroids?
It is, but it goes deeper. They are essentially admitting their global physical network is obsolete. The whole e-commerce shift, the need for faster innovation cycles. You simply cannot compete if your factories are rigid. And they have to do this because volume is just completely broken.
Because people are broke, or at least they feel broke. And I have to say, I appreciate how transparent they were about this on the call. I actually pulled a quote from the CEO. He said, "Rather than hope for the consumer to improve, we are moving with even greater urgency to meet consumers where they are."
Right, which translates to, we finally accept no one is coming to save us.
Exactly. The macro cavalry is definitely not coming.
It really is not. The pandemic-era pricing power is, well, it is dead. So if you can no longer raise prices and your baseline organic volume is getting hammered because everyone is coupon hunting, you're cornered. You either cut costs to the bone or you make a product people absolutely feel they need to buy.
Okay, and that brings up the second part of their survival strategy. They keep tossing around this internal term, remarkability. The goal is to drive a step change in the remarkability of their brands.
It sounds a bit like marketing fluff, but they actually mean aggressive nutritional engineering.
Okay, meaning what in practical terms?
Meaning they looked at school-aged kids and realized parents are completely obsessing over protein. So they rolled out Annie's Super Mac. It has 15 grams of protein, 6 grams of fiber, and retail sales for that specific product shot up 80%. Plus, they're pushing things like Tabasco-flavored Old El Paso shells or tying the Annie's brand to Bluey.
That is actually a very smart pivot because if you think about it, in a strained environment, a standard box of macaroni is a pure commodity. You just buy the store brand for half the price.
Exactly. The private label takes over.
Right, but if you stuff it with protein and slap a trending cartoon dog on it, suddenly it is a highly specialized product. That justifies the premium price. They are basically trying to innovate their way out of a margin trap.
It feels like they realize nostalgia is not enough anymore. Just being Cheerios or Totino's pizza rolls will not cut it. Actually, Totino's was one of their absolute worst performers this quarter, right down there with the Wilderness dog food line.
Yeah, management noted those two brands alone drove more than half the total volume declines in their respective segments. It's a harsh reality check. And if you look closely at their cash flow, it shows you how incredibly defensive they are getting.
Wait, I thought free cash flow was decent.
It was roughly $367 million for the quarter, but the CFO was very blunt on the call. They are freezing all strategic M&A. Acquisitions are totally deprioritized.
So what are they doing with the cash then?
Defending the castle. They are focusing purely on protecting the dividend, paying down some of that $12 billion in long-term debt, and just buying back enough stock to offset their own equity compensation dilution.
Wow, so they're basically battening down the hatches, pumping money into debt reduction and internal supply chains instead of buying up trendy new startup brands?
Yes, they know the current house needs new plumbing before they can build an extension, and you cannot rapidly pivot to Tabasco broths and zero-dye pancake puffs if your factories are only built to crank out millions of identical frozen pizzas. The physical infrastructure has to match this new agility they want.
That really connects it all for me. You cannot be agile if your factories are stuck in 2015. But this brings up the obvious next question. Does completely carrying down the supply chain and adding protein to pasta actually fix the ship? Like, what does this actually mean for next quarter?
Well, for next quarter specifically, it means pain. I mean, they are completely sandbagging Q1. The CFO, he explicitly warned that the first quarter is going to land below their annual guidance ranges on both the top and bottom lines.
Oh, wow. Right, because they lose that 53rd week they had this year, so the baseline is already entirely skewed.
Partly, yeah. Losing the extra week creates, I think it is roughly an 11-point headwind to adjusted EPS for the year, but it is also just...
Sorry, the CFO actually cited expected shipment timing headwinds in retail.
Plus, he noted their cost savings will start low and ramp up over the course of the year. They are essentially taking all their lumps right out of the gate.
Which is, a classic turnaround playbook. You kitchen sink the first quarter of the new fiscal year, so the back half looks like this huge acceleration.
Exactly. So their full fiscal 2027 organic sales growth, they are targeting negative 1.5 to positive 0.5%.
Okay, so best case, they stay completely flat, and worst case, they shrink another 1.5% while trying to restructure.
Right. So... to answer your earlier question about whether the supply chain overhaul actually fixes the ship, I think eventually it makes the ship much more watertight, but they are still sailing into a massive macro storm. Adjusted EPS is guided to dip slightly down into the $3 range next year.
It's funny, though. We kind of give them a hard time for lighting billions of dollars on fire with those brand write-offs, but you really have to respect a management team that stops pretending. They're not waiting for this magical rebound in consumer confidence. They are completely re-engineering the physical business to survive where the consumer is right now.
Yeah. Optimism with a spreadsheet did not work. Now they are just trusting the spreadsheet. And ironically, the market seems to respect that level of discipline.
I guess it does, even if all our dogs have to suffer with basic discount kibble for a while.
They will survive.
They always do. All right, that feels like a good place to wrap up this General Mills autopsy. Thanks for hanging out with us, everyone.
See you member time.
If you want these earnings breakdowns to just magically show up in your feed whenever they drop, go ahead and follow the show. We actually put these episodes together with the help of AI, so we can get them out to you on the exact same day, which means we always love hearing your thoughts or which tickers you want us to tackle next. So just shoot us an email at earningsunscripted@datamadness.ca or grab that X link in the show notes.
Thanks for listening.